Welcome to week 3. This is John Hastings. This week in Investing Like John Hastings, you're going to learn how to make money Jim Cramer style. We're going to be going through a couple things, and perhaps maybe this should have been last week's seminar after I was reviewing some of the information, but I think it'll fit in real well here. So what we're going to be doing tonight is talking about capital markets, financial markets. Really, guys, the focus is how does it all work? Meaning, I invest my money, let me understand the infrastructure, let me understand how this game or this sort of world of finance actually works. Before we get going in it, I want to sort of recap where we are. So in week 1, we learned the fundamental rule, why are we investing? Meaning, what's our goal? What are we trying to achieve? We also talked about, okay, well, now that we have a goal, let's make a plan on how we're going to achieve this and how we're going to put our hard-earned capital to work so that we can generate a rate of return given our specific sort of risk tolerances and other constraints to help us achieve that goal. Now, once we have this plan in place, we have to decide, and this is what we talked about last week, where should we invest our money and how should we do it? And part of this discussion really centers around the business cycle and looking at the various components over this 10-year period of time and what's happening in the markets. And we'll talk about what markets are tonight, what's happening in the markets and how we should allocate our money. Do we put it in fixed income? Do we put it in equity and really, or do we just hold it in cash? Now, I really want to thank everyone for all the feedback and the questions that I received this last week. I'm just going to address one of the questions, which seems to be the common one, which is, well, guys, where do we know where we're at in the cycle? Meaning, okay, we have this business cycle, we don't want to invest in when things are peaking, right? We want to invest in when things are at the bottom. So how do we know when we're at the top and how do we know when we're at the bottom? Well, it's really difficult to figure this out, right? But, we can use some sort of probability to sort of say, well, if unemployment's really low, inflation is creeping up, meaning it's costing us a lot more to sort of buy things, and we're starting to see interest rates start to creep up a little bit, well, you can only assume that we're kind of nearing the top of this market, okay? And things are probably going to correct, or we're going to see a bit of a pullback or recession. Now, that's typically not when you want to invest your money, right? We don't want to put our money into the market at this point because it's almost fail certainty that we're going to lose it, okay? But depending on when we go back, we look at our goal, we look at our plan. I mean, if we have a very long-term horizon, frankly, you'll learn about this next week, it doesn't really matter, okay? Now, when we're thinking about the recession or when we're at the bottom, well, if people don't have jobs, if inflation is real low or is starting to kind of come down and interest rates are starting to correct, then we can kind of guess that we're close to the bottom. Okay, so that would be the ideal time as to when you actually want to invest your money. Okay, so those are the questions that we had last week. So tonight what we're going to be talking about really is what the heck is the financial market? Okay, and so, in short, the financial markets really refers to a broad set of rules and systems that are in place to enable financial transactions and to make sure that they can happen easily, legally, and with predictability among buyers and sellers of financial instruments. Okay, so these are stocks and bonds, these are transferring money and so forth. So really, when we have the financial market, we sort of, break it down to 2 pieces. And think of this when we're starting the financial markets, we're going down in the scale here. We have money markets, which really equates for, on borrowing money over a period of 1 year or less. Capital markets, which is, investing money over a period of, 1 year and more, okay? So within the capital markets, we kind of break it down into 2 pieces. So we have the primary market and we have the secondary market. And I know it's really confusing because we talk about markets and markets and markets, okay? So, and we're gonna break this down really, really more to the granular pieces here shortly, but high level. We have the primary markets, we have the secondary markets, which really is where a lot of us kind of focus our attention on. And within the secondary markets, we have financial exchanges and over-the-counter exchanges, okay? So I'm going to talk in a little bit more detail about all of these very, very shortly, okay? And again, the term market is often confusing because it really just refers to stocks exchanges like the New York Stock Exchange or the Toronto Stock Exchange, or simply more broadly when we're talking about the bond or stock markets. But it's, it's all one and the same kind of, okay? So the role of the capital markets, plain and simple. We have people needing money, so we have the primary market, so these are governments, these are businesses, and what they're hoping to do is raise money to help invest in, things like, for government, investing in athletes, so raising money to put into our athlete assistance program. Fortunately, I think they should be raising more, but that is that is neither here nor there. But really what they're hoping to do is raise some money to spend on social programs, to spend on infrastructure programs, to spend on a number of different things. So the roads, the hospitals, all the things that we use on a daily basis, they have to raise money somewhere. You then have this financial intermediary, and that's people like myself and Brian Price, who I hope is on the phone right now, or on this call, this webinar. And we are the bank. We are RBC, and everything goes through RBC. That's my one RBC, but for the night. No, you have financial intermediaries. So these are typically the banks and other sort of outlets that enable people like me and you, so the secondary market, the people that have money that want to invest it because we have too much money, we don't need to use it, it's just cash. So what we do is we say, okay, primary market, government, businesses, listen, we have some cash, we can help you, do what you need to do on the basis, as I said in week one, that we're going to earn some sort of rate of return, okay? So we have the primary market, we have a financial intermediary, and then we have the secondary market. More simply, think of it this way. You are the primary market. You need money to help you go and buy a house. You go to the bank to go and get a mortgage. The bank then goes to this secondary market of people that just have excess money that need to put it somewhere. They want to make it work. And so the bank then gets this money, says, hey, listen, I'm charging John here 3.5% for his mortgage. I'm then going to pay you maybe 3% for letting me borrow your money and putting it to work. And I'm going to take that 0.5% as sort of my cut in the grand scheme of things, okay? So that's kind of how it works on a more individual level. But think of the primary market as not just you and me, or just the general public buying houses. It's governments, it's businesses hoping to raise money, and then the secondary market are people that are looking to invest and so forth, okay? So the role of the capital markets is really, we have, as I said, we have these financial intermediaries, okay? We have sellers, which are really the people that are the borrowers or the issuers who really want to use the capital markets to generate financing, and they do this typically through, looking at issuing equity or what we define as stocks, or raising debt, and these are bonds, okay? So buyers include, as I said before, individual retail investors like you and I, institutional investors such as pension plans. So think of the Canadian pension plan, think of, teacher pension plan. Anyone who typically who works for a government will have a pension plan, and these are the guys that have big money that are looking to put it to work for a long period of time. You then have investment funds, such as like mutual funds. You have governments, you have nonprofit organizations, you have banks and other financial institutions, such as sort of like life insurance companies and credit unions, who all have money who are looking to put it to work in a certain way. So the role of the capital markets is really to facilitate this transaction. So it's to kind of shift money from the buyers to the sellers, right? And these are the people that are looking at, raising funds somehow, okay? So that's kind of the very, very broad basic components of the capital markets and the role. It's really just to facilitate payment, okay? So why we need this capital markets, why we need these people is because, once financing has been raised through the capital markets, governments can use the proceeds to pay interest on sort of existing debt, fund social programs, as I said, so paying folks like you and I as athletes to go and represent our nation and to help us train and travel around the world and just be absolute rock stars and just have a lot of fun. They need this to fund us. A funny story here. One of my friends who was a sprint paddler, they used to go to Florida all the time. And, these guys were well funded in the 2008, 2012 era because they've done so well at the Olympics. And they go to this one restaurant, and at the restaurant or the place, the owner there said, you guys are being paid by the Canadian government to do what you're doing? And my buddy was like, yeah, absolutely. And he just shook his head in disbelief. And he was referring to this massive party they had had the night before where basically all the Canadians were out and just rocking and partying. Well, that's sort of how governments, sort of their money is going to work. And frankly, it's a great time. So I have nothing to complain about that. But anyway, so going again, governments and capital markets are used to sort of raise these funds to help facilitate stuff like this, more specifically roads and hospitals and airports and things that really add value to Canadians and make our lives a lot better. But oftentimes these are things that generate income for the governments that are using them. So think of the 407 ETR highway in Toronto area or the Greater Toronto area, something that is generating income for the investors through toll roads and so forth. Corporations use capital markets to help them, I guess, sustain their operations, expand their businesses by upgrading equipment, hiring personnel, and really just helping them grow and generate more revenue. So things that are going to help the company grow and expand, and that just sort of makes logical sense, right? When you're a company, it's like you're a company, you're looking at expanding. Well, you need capital to do that, right? You can't just typically grow organically. You need someone to help you. You need someone to invest in you. And think of this, if you're an entrepreneur, you want to go and create a business, well, you need money to make that happen. So you go out and solicit investors to do that for you. And so that's really what the capital markets are doing for us, okay? So within the capital markets, we really have two classes. So we have the bond market, we have the stock market. Believe it or not, the bond market is actually the larger of the two components of this. Bond market is about 92 trillion in 2016 numbers, and the equity markets are only 70 trillion. The main difference between this is really it's governments can't raise equity, so they can't use the stock market. They have to typically just use the bond market, okay? So they have the ability to just really tap into the space, and that's what they typically do. So understanding, financial marketplaces. So, really what I wanted to do here was sort of make you understand how it is that we sort of, I guess, interact and exchange and so forth. And so think of yourself as, as a consumer. As a consumer, you need some specific goods such as ice cream. Well, you're not going to go online to order ice cream. You're going to go to Baskin-Robbins or Dairy Queen or wherever to get it. You need a coffee. You need a donut. You go to Tim Hortons and so forth. So I think you guys get the idea. More broadly speaking, though, if you, as more general, what we're looking at here is saying, if we need to go to IKEA to buy furniture, we can go there. And now we're starting to see more and more often is that, things are becoming more online, right? And we're able to make transactions online and so forth. The point I guess I'm trying to drive home, and I just realized that I probably confused some people or didn't really make a whole lot of sense there, is that there's different places where we go to buy stuff, okay? If it's something that's a hard good, we typically buy it like ice cream or some sort of food. We'll typically buy it at a store. Other stuff we can buy online and so forth. It just goes to show you that there's a number of different places where we can go and purchase things, and it can be online, it can be in a store, it can be very specific, or it can be very general, right? And so I had this conversation with a client of mine the other day. He wanted to buy some shares of Amazon, and so he thought that I could go to all these different stores to go and buy shares of Amazon, and that I could kind of go and barter and negotiate wherever it was that I was going to do this. Well, no, there's only one place where I can buy shares of Amazon, and that's through the NASDAQ or the New York Stock Exchange, right? And so it sort of, it kind of baffled him because he didn't realize that at the time. So as consumers, we have different places where we can go and buy stuff. I can go to buy bananas at Loblaws. I can buy them at Metro. I can buy them anywhere, right? And so it just goes to show you that, as consumers, we have different places we can buy stuff, okay? So as we kind of go forward, though, if we want to go and buy stock and bonds, we really have two primary options. So we have the financial exchange. Okay, so we look at the x-axis here. We can purchase things on a financial exchange, which is really just like a clearinghouse. Okay, so this is a place where, excuse me, this is a place where there's a centralized body and they sort of organize sort of the people that are looking at buying and the people that are looking at selling, okay? Over the counter, it's a little bit, it's still well organized, but it's a little bit more broad in spectrum. There's dealers, there's a whole bunch of different individuals. So I like to call this sort of, you know, when you're thinking over the counter, think of it as a sense of like a dealership, like a car dealership, where you can go into a car dealership and you can go buy a car, but the price you pay may be a little different than the price the person before you paid. And that's because you're able to negotiate more and so forth. And, you know, say for instance, you want a specific car, say you want a Dodge Ram, well, you can go buy it from the Dodge store or the Dodge dealership, or you can go to a used car dealership and you can sort of negotiate the price and you can kind of, you know, have a little bit more wiggle room. Where in the financial exchanges, it's a little bit more structured, and there's someone who's selling and there's someone who's buying, and you can only buy and sell the one item there. So you can only buy and sell shares of, say, Royal Bank there. Well, guess what? The price can't necessarily be negotiated that much or that easily. Okay, you can't. There's no interaction between me and the other person. Okay, so why is this important? Well, with respect to buying stocks and bonds, typically you're going to be buying stocks using the financial exchange, where bonds you're typically going to be buying them using an over-the-counter sort of market as sort of defined here, okay? So making this a little bit more broadly, or just kind of driving the point home, I hope, with bonds, again, or sort of over-the-counter, again, it's a dealer network. So you have, you know, you have a broker who is buying and selling and helping a customer. So customer A calls up broker B, says, hey, listen, I want to sell my bonds in company XYZ. Broker B knows that customer B is looking for bonds, so he or she goes and negotiates a deal between the two customers. So they basically create this selling thing. So think of it as like a Kijiji, well, not really a Kijiji because that's more of a financial exchange, but again, going back to the dealership, think of it as a dealership where, you know, the broker kind of has a lot of power, or the real estate. Real estate's a great example for this story, because a real estate agent knows that there's a seller and they know that there's a buyer, and so they're able to bring the two people together to make a transaction, and they collect some sort of commission on the sale, okay? With financial exchanges, it becomes a little bit less sort of, as I said, customizable, or sort of, you know, brokerage-ish, if that's a proper term. There's no real sort of bartering and buying and, you know, trying to negotiate the price. There's one price, that's it. So my client who wanted to buy all these shares on Amazon, he thought I could, you know, because the size of the order was so large, I could go in and get a great price. Well, I told him very specifically and clearly, no, that's not the case. You cannot do that. There's a price that someone's willing to sell, and there's a price that someone's willing to buy. And you basically, if you want to buy and your demand for it is so high, well, guess what? You're going to be buying that, or buying it at the price that the person wants to sell. Okay, so within financial exchanges, I mean, you're gonna be selling, you know, typically products such as exchange traded funds, options, derivatives, common stocks, preferred shares, and so forth, right? So performance is a big thing in all this, right? Because what we're trying to do is because there's all these transactions happening every single day, what we're trying to understand is, okay, well, how are things going, right? We want to make sure we can have a gauge on the market activity, okay? And so if you're buying and selling, depending if you're an over-the-counter or if you're in using a financial exchange, this is a stock exchange, if things are going up, so if there's a bull market and the prices are going up, that means the price that someone's willing to sell you something is going to be increasing, okay? But if we're sort of, there's pessimism and prices are going down, well, guess what? We're entering a bear market. So if you're looking at selling something, well, the price that you were hoping to getting, you're probably not going to be able to get it. You're going to have to sell it for a lot less. But if you're a buyer, well, bear market's a great time because you can typically get a better price on something because, well, there's just not a lot of people, or there's a lot more optionality. So you probably heard of these things called the buyer's market or seller's market, and I'm assuming that's, if you've ever kind of looked at real estate, that's, you've heard that expression before. So in a buyer's market, it means the buyer has a lot of control. It means there's a lot of supply out there. There's a lot of houses that are available for sale. and that would sort of, if you're a buyer, that would be great in the bull market, right? Because, well, you have a lot more, or sorry, that'd be more aligned with the bear market because you just have a lot more control over the price you pay. Now, if it's a seller's market, it means that there's not a lot of supply, and you have a lot more control over the price, typically meaning you're going to be probably wanting someone to pay you a lot more. So prices are going up. There's a lot of optimism, okay? And the same goes for stocks and bonds and markets, okay? So if people are optimistic about the market because, we're in the business cycle and we're in that upward trend, well, guess what? Prices are going to be going up. And, well, it's a good time to be invested. But if we're entering that sort of recessionary period of time, well, we're going to be going into what's called a bear market. Prices are going to be going down, which means that as a buyer, well, you have a lot more power, and as a seller, well, you're kind of in tough times. Okay. Now, the reason why they're called bull markets, just by virtue of the way the animals attack, I suppose. Bulls have their head up or their horns are up, or a bear will attack with its head down. So that's sort of a little tidbit of information for you to kind of have in your trivia sleeve. So next time you're over at the pub or whatever playing trivia, well, you have a little bit more. So indices. This is another big indicator, and it's really aligned with more of those financial exchanges, okay? We have buyers and sellers, financial intermediaries. They need information about how the overall market is sort of kind of working and how their investments are changing in value. And so, the terms bull and bear market are great. They're good at describing sort of the broad general or directional moves up and down. Having a measure of the indice is even more important, okay? And so, what we can do is we can sort of compare market activity using the indice every single day. So, if you look at the newspaper or you look on Google Finance or whatever it is, you'll see sort of, the S&P TSX 60 or whatever it may be, and you'll see it's either going to be green or red, and that sort of gives an indication as to the market's up if it's green, or if it's red, the market's down, okay? And so if you're a regular observer of the market, you'll have a better understanding as to, if you're not just looking if it's green or red, you'll know, okay, if it's green and it says, it's up 1.2%, that means it's a really good day in the market and there's a lot of optimism. But if it's down, or if it's only up, say, 0.1%, it means there's optimism in the market, but to a lesser degree. And so if you're like me and this is your job and you're doing this every day, you kind of have an indication as to where the market's going, okay? And the same thing goes on the if it's red. If it's red by a lot, if you see a lot of the market is coming down, then that's kind of a bad thing, right? And it gives you sort of an overall understanding as to where things are going. Now, what we're looking at is not necessarily on a day-to-day basis, but we're looking on a trend, okay? So another, indication for those folks who were asking those questions last week about where are we in the business cycle, well, just look at the general direction of the market, okay? And so if the market is kind of going up, it means, well, we're probably in this sort of upward cycle. Things are going well, the market's going well. Now, if we're sort of tracking down, well, as you can imagine, that means we're probably kind of going into the recessionary sort of period. The market's a little bit more instantaneous than anything. It's a very quick read. So, as a doctor will put a thermometer in your mouth and they'll be like, oh, geez, your temperature is really high. It's instantaneous. You have a fever if your temperature's high, right? And so, if you look back at the data and you see sort of the financial crisis in 2008, 2009, you can see over a period of a couple of days, the market drops by 30 to 50% of value, right? I don't know the exact number, but a significant amount of loss. And then over the long period of time, so say 6 months or a year, you can sort of see the broad trend with the market kind of going down 25, 30, 40%, right? And then on the flip side, you'll see the market over a long period of time kind of following this trend line going up. And that could be indicating, okay, well, things are improving, and, this would be an idea to, well, either buy or sell, depending on what your objectives are. So indices can be classified in various ways. Okay, so we have sort of a global broad index that kind of tells the health of the overall world. We have regional indices. So these could be, say, Asia, Europe, Africa, Japan, North America. Then we have national ones, which say, okay, well, how are things specifically going in, say, Canada or the U.S.? We then have industry. So, for instance, in Canada, it's the biggest eyes are typically on, financials and the financial industry and the energy industry. And so we use this index to kind of say, oh, how are things going in this space in general, right? The indexes we can also use exchanges. So these are more specialized things, and these are really prevalent with exchange traded funds these days because these are basically index related investments, and so they're more customizable. Now, indices can be used in a number of different ways. It's a to gauge sort of, again, as I said, the general direction of the market. Are we in a bear? Are we bull? You know, how is this particular area going? And it helps us gauge our investment decisions, right? So if we continually see a particular industry kind of falling, well, it starts to, you know, get us thinking and asking questions. Well, why is it falling? Is this an opportunity to buy? Is there an opportunity to sort of invest our money? Or is there this more broader indication as to things that should be coming down the road? So for instance, you know, again, going back to the whole notion as to, oh, where are we in the cycle? You know, typically in late stages of cycles, commodity prices go up. So as we can see, the price of oil is starting to rally. The energy industry in the U.S. is starting to peak up. In Canada, it's not so much, but that's because of other issues. But you know, in general, these are some of the indicators that help us decide as to, you know, when we're allocating assets more broadly, what we're looking at. Okay. Further, you know, someone asked me last week, or I got a question last week about, well, you know, talking about trade and the impact of trade and on just the general market. Well, if we look nationally, the U.S. has been the one benefactor or the beneficiary of these trade disputes that are happening globally, where nations like China and Canada and just, you know, the international markets in general have been quite down, and that's because we're sort of feeling the impact of a lot of this geopolitical tension and uncertainty. Okay, so you can kind of see the correlation as to, okay, well, what's happening more broadly with these various sort of countries in terms of what's happening economically with issues like trade or else or otherwise. Okay. So we measure sort of the change in an index by looking at sort of, you know, a percent change. So various indexes are very large, and they're constructed in different ways, and that's beyond the sort of the scope of the context of this material. But really what we're looking at is, you know, we try to measure in percentage points because that's more respective. It sort of normalizes it across the board. So, you know, even though an index may rise 50 points, it only represents, say, a, you know, half percentage point increase, where another index, which may rise 50%, could mean the thing's up 2 or 3%, right? It's all dependent on how the index is kind of calculated. So there's a few, you know, 10 major sectors, and this has kind of changed though. There's recent changes. So, you know, this is indicative of the U.S. stock exchange. These are the major sectors that we typically look at, but these have been expanded and changed just recently, actually in the last 2 weeks. You know, the biggest thing is understanding, you know, the different weights within a portfolio or sort of within an index, right? And this is quite interesting. You know, when we look at Canada versus the U.S., you know, they're all very different, right? So, you know, for instance, as I was saying earlier, you know, the Canadian index, it's down right now. And it's surprising it's down, well, because of what I was saying earlier about how energy is starting to rally and the price of oil is going up. Considering that energy is a large component of the TSX index versus, say, the U.S., which you know, has a lower component of energy in its index, it doesn't make sense. But there's other issues at bay right now as to why the energy industry in Canada is struggling versus, you know, why it isn't in the U.S. And that's more political reasons, as you probably have followed the Trans Mountain discussions and so forth. So that's kind of why. So because of these various aspects, you know, the Canadian index or the Canadian, just Canada in general, is struggling. Whereas, you know, if we look at the U.S. and talk about why the U.S. has done so well this last year, when you look at information technology, so just technology in general, it's such a large component of the U.S. index. So, you know, we've all seen the rise of, say, Amazon and Apple and other constituents of this IT or this tech index. And that's really what's boosting the rest of the U.S. sort of the S&P 500 index. Okay. So here's one last question for you guys before I conclude everything here. It's to kind of ask the question, okay, well, what is Canada typically known for? And I was hoping we'd have a little bit more time to kind of do this, but the S&P TSX is known more broadly for its mining and energy stocks. Okay. So just to recap tonight, and I know I talked a lot, but because I'm on the webinar leading it, that's why. But money markets are we have these broad general markets. Money markets are more short-term in nature, while capital markets are a little bit more longer term. Companies look to raise money, through these capital markets to fund growth and projects. And as investors, we typically invest our money via the capital markets. Okay. If anyone has questions, by all means, just send them away. I love getting them. I love answering them, and I'm happy to kind of look at them. I think they're great. Also, too, if anyone has feedback on ways I can make this more entertaining or more informational, I'm more than willing to accept that. So I want to thank you, everyone, for your time tonight. This concludes week 3 of our financial simulation program. Look forward to chatting next week.